Hi everyone, my name is Jeremy from Phillip Securities Research. So for today, I'll be going through some market updates from the US side. So last Friday, especially last week itself, we saw a huge sell-down within the equity market. So is that main concern right now moving forward to see whether the correction might actually last longer than expected? So what we see moving forward, at least from some perspective of recession tracker, I'll just highlight what the VIX Index is showing currently. So VIX Index right now is kind of showing some crack signs. So for last year itself, we saw two episodes of it. October and November period, we saw the S&P 500 was only down around 2% each or so during the period. But what happened is in the VIX Index, we actually saw a sharp spike within the VIX Index of around 30 to 40% during both episodes. And even more recently, since last week, last Monday and last Tuesday, the S&P 500 only shed around 2%. The VIX Index actually spiked up 40%. And more recently on Friday itself, we saw the S&P 500 on the daily basis fell about 2.4%. The VIX Index once again spiked up around 30-ish%. So all in all, in terms of the VIX Index wise, we believe that the turmoil is actually coming off on the volatility side of things rather than equity market. And hence, the main thing to look out for moving forward for major crack signs is to watch the VIX Index. And based on our study, our recession tracker, the critical threshold for the VIX Index right now is hovering around 27.7 each level. VIX Index as of last Friday trades around 17.5. So all in all, for us to actually call for sustained weakness within the equity market, we need to see further prolonged spike within the VIX Index to above 27.7 for us to call that particular move. Okay, moving on. So here's the list of recession tracker that we actually watch. So basically, for those that don't know, the recession tracker basically tracks a list of 15 indicators covering both economical data, technical data, as well as market-based data. And all in all, pays attention to the extreme right column of the particular table. You can see there the bearish signal is actually not unconfirmed yet, which tells us that we believe that in the long run, at least moving forward a few more months, the equity market still has a leg to go to the upside. And what we see is based on three of the indicators, the TED spread, the 210 spread, as well as the VIX Index. All these indicators are still pointing out towards at least on average another 8 more months of growth, 8 more months of upside for the equity market before we see more prolonged kind of correction. So all in all, we believe the market should continue to step higher, being with the 20 and 60-day moving average actually holding the particular uptrend intact. In detail wise, how we actually get the time frame for the 8-month kind of a time frame to call for more prolonged period of correction is, you can see over here, we have the 210 spread, basically measures the difference between the 10-year Treasury yield and the 2-year Treasury yield. This is a proxy for the yield curve. So here's the recession timeline that we actually seen. So just to illustrate the chart, top panel over there shows the 210 spread, bottom panel shows the Fed funds rate. And you can see historically there is an inverse correlation between the Fed funds rate and the 210 spread. And what I mean by that is you can see every rate hike cycle in the past actually led to the flattening of the 210 spread and ultimately to the inversion of the yield curve. And why is this a huge problem? It's because historically once the 210 spread actually falls below zero and actually goes into inversion, recession is not too far away. On average, it lags around 1 year or so. So right now, we're actually embarking in this rate hike cycle that began in December of 2015, and we saw interest rate rose from 0.25% to the current level of 1.5%. And according to the Fed Funds projection, we are actually expecting another 3 more rate hike this year. So that will leave interest rate up from 1.5% to 2.25%. And based on history, you can see we believe that this flattening of the yield curve should continue to stay intact. And our base case study tells us that it will still require the market another 8 more months of flattening before we see the 210 spread actually falls below the zero line. And once that happens, we believe that will actually bring in some kind of a market panic. And in terms of more prolonged sell-off within the market when we see a 210 spread actually falling below the zero line. And all in all, right now, we are still seeing further upside within the market, easily still calling for another 8 more months of upside for the general equity market based on the 210 spread. After covering the long-term perspective from the previous few charts, right now diving more deeply into the current image of what the S&P 500 is doing. So you can see at the top right side of the particular chart, you've seen actually volatility picking up, S&P 500 seeing pretty big sell-off day, at least from last week's perspective. And all in all, in terms of the chart-wise, the trend-wise, you can see since 2017, the S&P 500 has been moving pretty nicely in this uptrend with the help of the 20 and 60-day moving average, which is the red and blue line on the particular chart. So you can see every correction since 2017 that happened, you can see it's being firmly supported by the 20 and 60-day moving average. And we believe since the recession tracker right now are still in the rosy kind of a picture, calling for another 8 more months of upside. We believe this stair-stepping motion within the S&P 500 index should continue to play out, which should then actually translate to the current price action that we are going to see right now, which is the key level to watch out for is the 60-day moving average, right now hovering around 2,712 points. In terms of psychological number, 2,700 points seems likely for the particular S&P 500 index to actually form its floor. So moving forward, we believe at least for another 8 more months out, this particular upward trajectory within the S&P 500 should continue to stay, and the 20 and 60-day moving average should continue to propel price higher moving forward. And yeah, in summary, so like I just shown the long-term perspective and the short-term perspective, we still believe that the US equity market has further room to grow. And since now the recession tracker right now are actually breaching its threshold, we believe this equity market has further room to grow to the upside until the recession tracker actually breaches its respective threshold. And in terms of catching the deep buys, we believe the 20 and 60-day moving average should provide investors some kind of guideline in terms of getting into the market for buying the dip and to call for the end of the correction. So our long-term perspective and short-term perspective do actually provide some kind of a deep buying perspective, deep buying opportunities from the market perspective. So all in all, yeah, that's our bullish case for the S&P 500, or at least the general equity market in the US. Thank you guys for watching. That's all for today. So if you have more queries and want to know more about reports, head on to stocksbnb.com. Thank you.